is this policy or objective of reducing demand by 15% actually going to be?
Well, we think it's going to struggle a little bit. As you say, there are many carve-outs for a bunch of different countries across the EU just to get this basically past the finishing line. When they initially proposed it, it met with fierce opposition from various countries which were better placed to weather the storm of reduced Russian flows, countries with lots of energy infrastructure, countries which are less reliant on Russian gas, or countries that, for one reason or another, can still import some Russian gas, like Hungary. So there was a lot of opposition to this initially. Then they managed to give these carve-outs, and we estimate that around about 33, 34 BCM of actual savings are embedded within this new 15% savings plan. And that waters that down to about 11% against the 5-year average. Now, because we've had high prices for a long time, actually a lot of that is already baked in, because we've had high prices squeezing industrial gas consumption, power sector gas consumption, even hitting the residential commercial sector. So we're talking about these plans potentially doing an extra 20 BCM above what we're expecting over the course of this winter. It's not a huge amount. It's just about enough to weather a full Russian halt, at a push.
It's interesting that you say it is just about enough to weather a full Russian hold, because that's been the big question for markets. And we've been following and tracking the price of TTF very, very closely. We're trading at around 200 euros now per megawatt. Would you say these levels are justified based on what we're looking at heading into the European winter?
Well, what we're trying to do with prices in Europe is to get gas into storage. We've got mandatory storage fill targets for the end of this October, end of next October. And so for Europe to feel secure in its gas supply over peak winter, when it gets very cold, they're trying to make sure that we've got enough inventories going into this winter. And what that means is having to basically get that gas from somewhere. And we've already maximized supply from every direction that we can, from Norway, from LNG coming in. And so now what we're trying to do is just kill off that industrial demand. And that's a very inelastic part of the demand curve. And as a rough rule of thumb, for every 1 BCM that you're trying to loosen up the European market, you're having to move up about 10 euros at the TTF. And that's why we can get these huge jumps from, last year, up to 190. This year, we've been going up to intraday into 300, settling around about 200 at the moment. And the long-term average is between 10 and 20. So it's really a tenfold increase in these gas prices just to squeeze out that industrial demand.